Hey guys. Hey guys. Anthony here. Sorry I'm not being loud. It's 11:40 in the morning, but I don't know. I have this thing where like I kind of give up on the end of the day, then go to bed at like 8 or 9 o'clock because I'm like, all right, I give up on today. We'll start tomorrow on a new day and everything. So I did that and I couldn't sleep. So now it's 11:40 and I'm like, oh, scratchy throat. I guess if you guys want a hair transplant update, it's all red and it looks like I'm going balder than I was before. 6 months from now, we'll have some hair. That's how it was last time. Anyway, this video is about my next investment into cryptocurrency stuff. And now what I saw today, I'm not so sure that I'm still going to do this. Yeah, so as you guys know, I'm going to explain like my thought process through this and how I ended up in this conclusion and everything. But as you guys know, like from my previous videos, I've been like experimenting with Ethereum Prism, which is a implementation of Ethereum proof of stake. So basically you stake 32 Ether to help validate blocks on the network and network transactions and all that. And then you get paid a little bit of Ether for doing so. At current prices, it seems like the information I did, you get like $480 worth of Ether per year, which is okay. I mined Litecoin for much less than that back in 2014 because I believed Litecoin and cryptocurrency as a whole would go up in value. So I mined Litecoin. I mined Litecoin at like, when I stopped, I was making negative money per month. I decided I would run negative for a couple months after, but I was only making like $40 a month or something at times, which I didn't even care about. I didn't need that money to survive or anything, so it was okay. So I suppose I could use that same logic with validating for Ethereum. It's just like I want more than $480 a year. Like I get kind of, I feel like maybe I'm more impatient now. And yeah, so then mining Litecoin. I'm reading off of stuff that I wrote the other day, but then like mining Litecoin, I ended up trading for Ethereum in October of 2015. So yeah, but the goal or the idea is like my cryptocurrency, and this is like a reoccurring theme in cryptocurrency over the last year, is that there's people who have so much money in cryptocurrency that's just stored there, just sitting around as a store of value, and it's not really doing anything. And if you put your cryptocurrency into something like proof of stake, then your cryptocurrency will be doing work for you and making more money for you and growing in value. So that's why I was going down this path. There's also like a Reddit post or something saying that like, oh, Prism or Ethereum 2.0 is coming soon, and to get ready and all that, which I still don't know, but that's why I started like revisiting this topic. So if I was going to do this, I would build a dedicated server for my server rack down here. And I wouldn't just want like, I would want to optimize the server that I build to make as much profit as possible. So it wouldn't just be running, the plan that I had built in my head is that it wouldn't just be running Ethereum's proof of stake. It would also be running different proof of stake blockchains to make money off of those as well. So in order to do this, and I want like good hardware for it, I don't know how many cores I would need. Say that I'm running like 5 or 6 different blockchains. I don't know how many core CPU I would need, but it's better to go overboard. That's the way that I do things with computers. It's better to have more processing power than you need than to have too little, because then you have to rebuild the entire machine because you didn't plan it to spec. This machine would have cost me like $1,000, $1,100 around there, roughly speaking. And I'm thinking like $1,100 to make $480 a year to, I don't know, say it's like a 5%. All right, so say that's like 480, and I did this at price was 165 per Ether, so a little bit less than 3 Ether per year. So 3 times, let's say like Ether, it gets to be worth like $1,100. So that's only $3,300, and that's betting on the price of Ether reaching 1,100 in the next 3 years or so. So it doesn't seem like that big of a payoff. So the other thing that I want to talk about with running a server machine with multiple cryptocurrencies on it, I would be trading some of my Ether for these different cryptocurrencies in order to stake those different cryptocurrencies. So when I do that, that takes me out of the Ethereum market. So I'm not exposed to the Ethereum price going up anymore. I would be exposed to, say, I don't know, I think like Tezos is one of the proof of stake blockchains. Don't mind me like touching my hair, I'm just playing around. So say like Tezos is one of those blockchains. Now I would have my money invested in Tezos, and I'm not sure how that I really believe in it, that its price will go up. Not to say that it's bad or anything, I just haven't researched it to make that decision. And I do believe in Ethereum still. So I would rather not lose my exposure to that by doing proof of stake stuff on different blockchains. So that's where I'm coming from that. I hope you guys understand what I'm trying to say here, that if I build this server machine and stake multiple cryptocurrencies on it, I would have to exchange my Ethereum for these multiple cryptocurrencies. But in doing so, even though I might make 4 to 6% a year on what I'm staking in these different cryptocurrencies, I'd be losing the exposure I have to Ethereum's price going up, which in the last year, I think Ethereum went up like 20% or something like that. Well, I'll double check that now just so I'm accurate. Yeah, right now Ethereum went up 44.11% in the last year. And that's like from this low to this low. That's not even counting like all of this. So I lose all of my exposure. So to make 6% on Tezos or whatever doesn't make sense because I'm losing all of this. I hope you guys understand that, understand what I'm trying to say. So additionally, on top of that, like trading my Ether for these cryptocurrencies is a tax event that I have to pay taxes on. So that's more money I lose and I would have to make up in this endeavor. Also, doing this makes my taxes more complicated, having multiple staking cryptocurrencies, like not just trading the Ethereum for these other coins to stake, but then earning rewards for staking these cryptocurrencies makes my taxes more complicated. And I don't like having complicated taxes. I like my life being really simple and easy. The more complicated things are, the more I have to pay attention to things, and then the more mistakes I make because I don't have enough attention to pay to keep everything like perfect. And also then I have less time to do my own things. So I like to keep things simple. Yeah, so that's when I came across the other idea. And that's where there's a lot of things that I've been reading about lately. And it seemed to just have boomed like right after I started researching it. Like a week after I researched it, like now I see like posts about it all the time, which I guess is like, you also notice the same thing, like say like you're in the market for a Jeep Wrangler or something, and now you notice like more Jeep Wranglers on the street now. So maybe that's the effect that it had. But anyway, with this like decentralized finance stuff, and basically what's going on is that you can think of it as like a savings account or something, to where, like I was mentioning before, with like your cryptocurrency just sitting around doing nothing, well, you can put it into like a savings account the same way as like a bank savings account works or whatever, and then you can earn interest on that money for being put in the savings account. And the way that it works is that the bank is actually investing your money or loaning it out to other people, and they loan it at a higher interest rate than they pay you. So they get a profit from it, and then you get a profit in the form of your interest rate. So I was looking into that, and there's one that I was going to invest into, and I'm not so sure yet. I have to rerun the numbers, but it was it is called BlockFi. They had 6.2% interest gains on Bitcoin, 4.1% on Ethereum, 8.6% on stable coins. So like USDC and GUSD, which is the Gemini US dollar. And the good thing about this is those interest rates are compounding. So let's say that you put in $1,000 at 10% interest. Just for like simplicity's sake, we'll use 1,000 and 10%. So the first month you'll get $100 in interest. So now you'll have $1,100. So now that $1,100 is earning 10% interest. So month 2 you'll have $1,210. Month 3 you'll have $1,331, and month 4 you'll have $1,464 and 10 cents, and so on. By the end of 12 months, if you don't touch any of that money and just leave it in the account earning compound interest, you'll have $3,138.43. So that's how this would work. The reason that I don't do this with a traditional bank by putting money into a traditional bank is because the interest rates are so low, like 0.1% or something. You need to invest like a lot of money to even get like 1 or 2% returns on with US dollars in traditional banks. And I think part of the reason that interest rates are so high for blockchain stuff right now is that I think there's like angel investors and people investing into BlockFi. So BlockFi is using some of their investment money to pay interest to attract new customers. So they raise interest rates to attract customers, and they're paying that interest with investment money. And I also think that bank rates are so low because the economy is kind of played out. Like all this stuff with BlockFi and decentralized interest or decentralized finance, earning interest on lending, is new. And one big advantage that this has on the lending side of things is that there's so many people that you could think of like the .com bubble, where like so many people wanted to get in on the internet and wanted to build websites and everything like that. And some of these people had like really good ideas, but didn't have good credit at the time to take out loans or anything like that. So this is the same thing, where there's a lot of people that have good ideas and they don't have like any way to raise money or capital to build out these ideas in the blockchain space. We used to have the ICO stuff, and even before that, like, yeah, I guess it's always been like an ICO, like Ethereum had an ICO, it just wasn't really called an ICO at the time. But we always had these ICOs where you could make your own coin and sell it as stock, and it could be like a utility token in the sense that it's useful on the network, like how Ethereum is useful on the network and blah, blah, blah. And that was like, you needed to have like programming and coding experience to be able to build and run your own blockchain to do this. But that's how we funded all these projects in the past. But now that these ICOs, now that the SEC and there's like securities regulations and KYC and AML laws and everything like that, now that companies are being watched by governments and stuff to make sure that they're not running like unregulated securities, essentially, the ICO model, it's a lot harder to fund yourself, to fund your projects doing that. And that's why you see like EOS going out to the Cayman Islands and all that. So the ICO thing is like gone. It's not totally gone. It's pretty much gone, or at least completely a lot harder to set up this stuff legally now. So we have to find a different way for all these people to get funded and take out loans and everything to build their businesses, to build out their blockchain ideas. So that's where like this decentralized lending comes in, and that's where there's a market for this, because people can take out loans on cryptocurrency now. So I can put in my cryptocurrency, and there's so many people this is where I'm arguing that interest rates are either high because there's venture capitalists coming in and paying higher interest rates to attract new customers, or because there's a lot of demand and there's a lot of people that still want to build blockchain projects and everything like that and need to get funded and don't have traditional funding methods through banks because of bad credit, or because they need their project to get approved and get like the thumbs up, like, oh, this is a good project, we're gonna fund you on that. With this decentralized lending, and that's kind of the danger of it too, I guess, but with this decentralized lending, you don't need to prove yourself or your project to get any money. So there could be a lot of demand too that's also driving up these interest rates. And the thing is that once this demand comes in, or once this demand like subsides, interest rates have to lower in order to maintain the system, to maintain the lending system. Because what happens is that, man, I'm going off on a tangent here, but it's important to explain all this stuff. But what happens is that when there's not a demand of blockchain projects needing money to take out loans and everything like that, needing loans, when there's not a big demand of blockchain projects needing money, well, then there's going to be more supply, more people investing to give out money. All right, I wrote down, it's crazy how like just 5 sentences or 6 sentences can confuse me so much. But what I'm trying to say is that the more people that make deposits, the more people that are making deposits, and the less people that are taking out loans. What I'm trying to say is that if there are more people making deposits than there are people taking out loans, well, then the money isn't coming in to pay the interest rates, the high interest rates on the deposits that are being made. Say you're loaning out Bitcoin at 10%, and or say you're paying deposits at 10% on Bitcoin, and then when people take out loans, they have to pay 20% on their loan. And then that 10% of that 20% goes to pay these depositors who loan the money. The other 10% goes back to BlockFi or whatever lending service it is. Well, if there's not enough people taking out loans, then there's not money to pay this 10% interest rate. So what happens is banks and BlockFi and lending services in general, they end up lowering the interest rates that they offer to depositors as a hope of signaling out to the market, to people who are considering loans, like, hey, interest rates are low. If you want to take out a loan, now is the time to do it because interest rates are low. And then this also helps stimulate the economy and keep this whole lending service stable. And I'm unsure if I actually believe that this is the right thing to do, because I know I believe in like free market capitalism and not manipulating economies and stuff like that, and to just let things run its course. But I'm not even thinking about that. That's kind of beyond the scope of this video. So with me investing cryptocurrency into something like BlockFi, into this scheme or whatever, there are some concerns and risks that I have to account for or think about. And one of them is that BlockFi can change interest rates at any time. So even though today interest rate on Ethereum is 4.2%, which is actually not, but we'll get into that at the end of this video or later in this video. But even though like interest rates are 4.2% now, they might not be that in the future. And I've already explained why that might not be the case. So say that like I'm looking at this and saying like, oh, I invest $15,000 in 5 years, I'll have $23,000 or whatever. That's only at today's interest rates, and I'm not sure how long that would last. So even though it looks like I'll have $23,000 in 5 years, it might not actually work out that way. It might only be $18,000, maybe not that low, $18,000, $20,000 or whatever. The next problem with this is BlockFi isn't insured by the FDIC or anything else like that, like traditional banks are. I believe they might be internally insured by Gemini, which is like the Winklevoss twins thing, which I'll talk about that later too. But as far as I can tell, if BlockFi is hacked or they go out of business, there's little to no recourse anyone can take to get their money back. They even have a clause on their website in their terms of service preventing people from filing a class action lawsuit against them, which I'm not sure is legal or if that will hold up in court, but I hope like no one ever finds out. So because they're not FDIC insured, that's a huge risk, especially like such a new company, to just lock your crypto in there. Like we all know, like if you don't control your private keys, you don't control your crypto, and don't keep your crypto on exchanges and everything like that. But earning interest on it is very enticing. So even though I have hundreds of thousands of dollars in cryptocurrency, I can't just put all of it out there because of this risk, because it's not insured, because of the risk of it getting hacked and stolen and everything like that. So that's why I was initially thinking like $30,000, even $30,000 I think is too much. And that's why I'm thinking now $15,000 and split that between Bitcoin and Ethereum. And the reason that I would do Bitcoin and Ethereum and not do their stable coin, which the stable coin is like 8.2% or 8.6% or something like that, is because what I was talking about previously about losing your exposure to price fluctuations in Ethereum and Bitcoin. A stablecoin is always going to be worth $1, and I think that's why interest rates are higher than that, because they want to attract people to come in with stablecoins, because if you're putting in Ethereum and Bitcoin, then the person who's taking out the loan, you have to convert it to cash and everything like that anyway, so there's more fees and it's more of a hassle. So they want to incentivize people to deposit stable coins. So BlockFi uses Gemini as their cryptocurrency custodian. So Gemini is holding a certain amount, I don't know how much, but Gemini is holding some of BlockFi's cryptocurrency in their cold storage to like protect it as like a custodian over it. There was an article recently that Gemini started its own insurance company. I reached out to BlockFi on Twitter to see if BlockFi is covered by this and if their users are covered by it, and I didn't get a response from them. So I just assume that it's more like business insurance or something, that BlockFi would be covered more than the users would be covered. Maybe just like users might get a small percentage of what they originally had in it. Oh geez, this is a long video, but we only have like a very little bit left to go. So I'm going to show you how much in 5 years or whatever, I think I have it on my laptop written out, but how much I'd make at these current interest rates. Well, I seriously haven't looked into this in forever, and this doesn't make any sense to me anymore. I have to figure that out. All right, so what we got here is two different things. So this first one is investing 1 Bitcoin at 6.2% interest and 36 Ethereum at 4.1% interest. I'll put it up just so you can follow along. 1 Bitcoin and 36 Ethereum. At the end of 1 year, I'll make $775. At the end of 2 years, $1,650. 3 years, $2,500. 4 years, $3,500. 5 years, $4,500. And keep in mind, there's like a lot of risks I can lose. This is just the profit that I'll make. At the end of 5 years, I'll have $18,000 off of an initial investment of 6, 9, 15. So I make like $4,500. So 6 years, $5,600, 7 years, $6,700, 8 years, almost $8,000, 9 years, $9,000, 10 years, $10,572. And also you have to keep in mind too that I'm still exposed to Bitcoin price fluctuation. So it does kind of make sense to do this in the sense that even though in 1 year I'll make $775, that's with Bitcoin and Ethereum's current prices today at, I did it with $8,800 for a price of Bitcoin and $165 per Ether. If Bitcoin and Ethereum go 10 times as much in value, I'll make $7,000, almost $8,000 in the first year. So I guess that does kind of make it seem decent. Let's say that I invest, instead of 1 Bitcoin, I invest 1.2 Bitcoins. Instead of 36 Ether, I invest 50 Ether. This puts me in around $19,000. So instead of $775 in the first year, I'll make $1,050. In 5 years, instead of $4,500, I'll make $5,650. Going down to 10 years, instead of 10 years, $10,572, I'll make $13,256 at current prices. And say that, like I said, say that Bitcoin and Ethereum go up in 10 years, that's even more money. So it seems like a good idea. Also, to mitigate the risk, you can go with different lending services. There's one that I didn't research that much called Compound Finance that I think is all done on the Ethereum blockchain. So there's no people involved at all. It's all in smart contracts and stuff like that. So I can split up, say I want to invest $20,000. I can split that up between different lending services. I don't know how that affects these numbers, the projected profit figures or whatever. I didn't look into anything like that, but that's another thing a person can do to mitigate the risk of putting all your money in BlockFi and it being stolen or hacked or lost or whatever. So additionally, to close off this video, remember how I was saying that BlockFi can change their interest rates at any time. Well, I got an email today, 7 hours ago on January 22nd, not even a week after I started researching all that. Bitcoin was previously, you can have 0 to 10 Bitcoins. They had a tiered service. So 0 to 10 Bitcoins was 6.2% interest. If you deposited more than 10 Bitcoins, it was a lower interest rate you would get paid. So now instead of 0 to 10 Bitcoins at 6.2%, now it's 0 to 5 Bitcoins at 5.1%, which doesn't affect what I was doing because I was only going to put 1 Bitcoin in. Ether was 0 to 1,000 at 4.1 or 4.2%. Now it's 0 to 500 at 3.6% interest. Stablecoin prices are still at 8.6% interest. Yeah, it does seem like a good idea though, doesn't it? But I mean, putting $20,000 in, this is what I'm thinking about. All right, guys, take care. I have no idea how long this video was, but that explains like everything, all my thoughts on it and all that. So take care, guys. Thank you and goodbye.